Despite decades of research, there is little consensus about the primary determinants of M&As. Research has focused on aggregate data, which may conceal important size, sector, and geographic differences. Some analysts argue markets are efficient because decisions are made rapidly in response to new data, but others see markets adjusting more slowly to changing conditions. Still others contend that microeconomic factors are more important determinants of M&As than macroeconomic considerations. The various theories are discussed in greater detail in the remainder of this section. Synergy is the value realized from the incremental cash flows generated by combining two businesses. If the market values of two firms are $100 million and $75 million, respectively, and their combined market value is $200 million, the implied value of synergy is $25 million. Although synergy may improve combined firm performance, growing coordination costs, e.g., increased communication, information processing, and joint decision-making, may worsen performance because of greater complexity. As firms become more complex, such costs may limit the expected benefits of synergy. The two basic types of synergy are operating and financial. Operating synergy consists of economies of scale and scope, as well as the acquisition of complementary resources such as technologies, skills, and materials. Economies of scale and scope explain why average total costs are often lower for larger firms. Whereas economies of scale focus on the cost advantage associated with a higher level of production for one good, economies of scope focus on the average total cost of producing multiple products. Economies of scope refers to the reduction in average total costs by producing multiple products or services from a single location rather than from separate locations. An example of production-related economies of scope is a mobile phone handset maker deciding to add a new line of phones. The cost would be lower if the manufacturer uses the same facility because it can use existing equipment, workforce, warehousing, and distribution. Common examples of overhead and sales-related economies of scope include having a single department, e.g., accounting, support multiple product lines and a sales force selling multiple related products rather than a single product. In addition, lower distribution costs can be achieved by transporting a number of products to a single location rather than a single product. Other examples include the savings realized by using specific skills or an asset currently used in producing a product to produce multiple products. Complementary resources such as technical assets, know-how, and skills are those possessed by one firm that could be used by another to fill gaps in or augment its capabilities. The merger between Pharmacia and Monsanto gave Pharmacia access to Monsanto's COX-2 inhibitors and Monsanto access to the other's genomics expertise. The merger allowed for expanded in-house clinical research and development and accelerated getting products to market. Financial synergy refers to the reduction in the acquirer's cost of capital due to a merger. This could occur if the merged firms have relatively uncorrelated cash flows, realize cost savings from lower securities issuance costs, or are better able to finance investment opportunities with internally generated funds, sometimes referred to as coinsurance. The imperfect correlation of business unit cash flows allows resources to be transferred from cash-rich units to cash-poor units as needed. As such, multi-product firms with less correlated business unit cash flows may be less risky than firms whose business unit cash flows are correlated. Target firms, unable to finance their investment opportunities, are said to be financially constrained, and they may view access to additional financing provided by an acquirer's unused borrowing capacity or excess cash balance as a form of financial synergy. Diversification. Buying firms beyond a company's current lines of business is called diversification. Diversification may create financial synergy that reduces the cost of capital. Alternatively, it may allow a firm to shift from its core product lines to those having higher growth prospects. The new product lines or target markets may be related or unrelated to the firm's current products or markets. The product market matrix illustrated in Table 1.3 identifies a firm's primary diversification options. A firm facing slower growth in its current markets may accelerate growth through related diversification by selling its current products in new markets. IBM acquired web-based human resource software maker Connexa to move its existing software business into the fiercely competitive but fast-growing market for delivering business applications via the Internet. A firm also may attempt to achieve higher growth by acquiring new products with which it is relatively unfamiliar and then selling them in familiar and less risky current markets. Retailer J.C. Penney's $3.3 billion acquisition of the Eckerd drugstore chain, a drug retailer, and Johnson & Johnson's $16 billion acquisition of Pfizer's consumer healthcare products line are examples of such. Related diversification. In each instance, the firm assumed additional risk by selling new products but into markets in which it had significant experience, J.C. Penney in consumer retail markets and J&J in retail healthcare markets. There is considerable evidence that acquisitions resulting in unrelated diversification more often result in lower financial returns when they are announced than non-diversifying acquisitions. Firms that operate in a number of largely unrelated industries are called conglomerates. Their prices often trade at a discount to shares of focused firms or to their value if broken up and sold as individual businesses. This conglomerate discount sometimes values such firms 15% lower than more focused firms in the same industry. Investors often perceive conglomerates as riskier because management has difficulty understanding these firms and may underinvest in attractive opportunities. Also, outside investors may have trouble in valuing the various parts of highly diversified firms. Likewise, investors may be reluctant to invest in firms whose management appears intent on diversifying to build empires rather than to improve performance. The larger the difference between conglomerates whose share prices trade below more focused firms, the greater the likelihood these diversified firms will engage in restructuring that increases their focus. Other researchers find evidence that the most successful mergers in developed countries are those that focus on deals that promote the acquirer's core business, largely reflecting their familiarity with such businesses. Related acquisitions may even be more likely to generate higher financial returns than unrelated deals because related firms are more likely to realize cost savings due to overlapping functions. Also, cross-border deals are more likely to be completed when the degree of relatedness between the acquiring and target firms is high. The conglomerate discount is not universally true. About 30% of U.S. publicly traded firms between 1976 and 2015 offered products in at least two or more distinct standard industrial classifications. Of these diversified firms, 43% traded at a premium compared with the sum of the market value of their individual businesses, with the remainder trading at or below their breakup value. Strategic realignment firms use M&As to adjust to such factors as regulatory changes and technological innovation. Industries subject to significant deregulation in recent years, financial services, healthcare, utilities, media, telecom, defense, have been at the center of M&A activity because deregulation breaks down artificial barriers and stimulates competition. Deregulation often sparks a flurry of M&A activity resulting in fewer competitors in the industry. Technological advances create new products and industries and force a restructuring of existing ones. Tablet computers reduced the demand for desktop and notebook computers, and e-readers reduced the popularity of hardback books. Services such as WhatsApp and Microsoft Skype erode a major source of mobile phone company revenue, voice and text messaging. Cloud computing allows firms to outsource their information technology operations. In the winner's curse, overconfident CEOs may pay more than the target is worth. Having overpaid, such acquirers may feel remorse, experiencing what is called the winner's curse. The presence of multiple bidders may contribute to overpaying as CEOs get caught up in the excitement of an auction. Moreover, overconfident CEOs tend to view their firms as undervalued. When such firms have substantial cash holdings, these CEOs are prone to avoid external financing as too costly and use this cash to overinvest and engage in excessive M&A activity. Buying undervalued assets. The Q ratio is the ratio of the market value of the acquirer's stock to the replacement cost of its assets. Firms can invest in new assets or obtain them by buying a company with a market value less than what it would cost to replace the assets, i.e., Q ratio less than 1. Managerialism, agency problems. Agency problems arise when the interests of managers and shareholders differ. Managers may make acquisitions to add to their prestige, to build their influence, to increase compensation, or for self-preservation. Such mismanagement can persist when a firm's shares are widely held because the cost of such negligence is spread across a large number of shareholders. Considerations. Acquirers of firms with accumulated losses and tax credits may use them to offset future profits. However, The taxable nature of the transaction often plays a more important role in determining whether a merger takes place than do any tax benefits accruing to the acquirer. Why? A properly structured deal allows the target shareholders to defer any capital gain until the acquirer's stock received in exchange for their shares is sold. Taxes also are an important factor motivating firms to move their corporate headquarters to low-cost countries. Market power. The market power theory suggests that firms merge to improve their ability to set product prices by reducing output or by colluding. Moreover, increased market power among firms supplying widely used inputs, such as oil and natural gas, across a broad spectrum of industries can be particularly harmful to society. Why? Such price increases are pervasive and tend to compound as they are passed up the various levels of production. However, recent studies conclude that increased merger activity is much more likely to contribute to improved operating efficiency than to increased market power. See Payoffs for Society? Section. Misvaluation. Absent full information, investors may incorrectly value a firm, especially for smaller firms receiving little financial media coverage. If a firm's shares are overvalued, undervalued, they are likely to decline, rise, in the long run to their true value as investors more accurately value such shares based on new information. Opportunistic acquirers may profit by buying undervalued targets for cash at a price below their actual value or by using overvalued equity, even if the target is overvalued, as long as the target is less overvalued than the bidding firm's stock. Overvalued shares enable the acquirer to purchase a target firm in a share-for-share exchange by issuing fewer shares, reducing the dilution of current acquirer shareholders in the combined companies. Misvaluation contributes to market inefficiencies. The winning bidder may not be the one with the greatest synergy, and the purchase price paid may exceed the target's true value. Acquirers using their overvalued stock to bid for a target can outbid others whose offers are limited to the extent of their potential synergy with the target firm. If the acquirer's purchase price is based more on its overvalued shares than on perceived synergy, it is unlikely to create as much value for shareholders than a bidder basing their offer solely on synergy. Such instances are rare, occurring in about 7% of deals. And the magnitude of the inefficiency on average is small. 0.17. However, even if the buyer fails to acquire the target, their presence bids up the price paid, thereby potentially causing the winning bidder to overpay for the target. The effects of misvaluation are short-lived because the overvaluation of an acquirer's share price often is reversed in 1 to 3 years as investors' enthusiasm about potential synergies wanes. Thank you for your listening.